Welcome, welcome, welcome to the Nest Egg Builder Show. Today we have Caeli Ridge. Caeli is the president and CEO of Ridge Lending Group and is a real estate investor herself. She has been an established real estate investor for over 20 years, holding as many as 42 investment properties across the United States at one time. Caeli has worked with tens of thousands of real estate investors and homeowners all over the country, helping families realize their dreams of home ownership as real estate investors more than any other mortgage lender in the country. When she is not running Ridge Lending Group, Caeli is a sought-after speaker and can be found providing insight and education to investors at events across the country. Located in Portland, Oregon, Caeli is also a wife, a mother of two, and a devoted friend to many. Thank you so much for joining us today, Caeli.
My pleasure. It's Jonah, right? I see your name back there. Or is this, did I get it wrong? You're Jonah.
Jonna. Yep.
Jonna.
Like Donna.
Got it. Jonah. Got it. Thank you. Thank you, Jonah.
Yeah, if you're not going to present, I'm going to spotlight you so we can focus.
Great.
Go ahead.
Hey, gang. Hi, thanks. Thanks, Jonah. Thank you guys for having me. Appreciate being here and able to share whatever information I can. That bio is a little bit dated. Anyway, thank you. It was very generous. So today, I'm going to talk to you guys about second lien mortgages. And just to kind of quickly, before I get into that, I should probably add a little bit more. Ridge Lending is unique in a few ways. We are licensed in 48 states. So we have a nice broad footprint. We're not in North Dakota or New York. Otherwise, we will be everywhere lending that you're interested in investing in. I've been doing this, as Jonah had read, 25 years. I think some of our value adds that I would just share with you really briefly are twofold. One, we focus a lot of our time and energy on education. I personally feel like that element of real estate investing is largely missing out there in the space that we're occupying. You know, you could dear Google whatever you want about financing, but I find that in doing that, it's either not going to be relevant to what the question is not applicable to you, is timed out, it's not valid information anymore. It's old thought or old guideline. But in any case, it's not going to be easy for you to find or gather on your own. Without the use of other people's money, however, what happens to our rate of return in investment, real estate investment? It's diminished greatly, right? If you don't have leverage, some kind of leverage, your ROIs are going to be much less than they would otherwise. So it just seems obvious to me that having some look under the hood of the underwriting guidelines as they apply to us investors, and your qualifications as they exist today, and then teaching you how to take all that information and optimize your qualifications from an underwriting perspective. Things like debt to income ratio, credit scores, assets. For us investors, those are not straight lines, right? Especially, it's not an owner-occupied transaction where we're just going to go purchase a home. We're buying and selling and refinancing. We're probably doing 1031 exchanges at some point. So inherently, our baseline qualifications are going to be fluid. Understanding how to qualify from that underwriter's perspective, and then teaching you guys, like I said a second ago, to optimize those things for the long term, setting you up with the information that says, here's how you read a Schedule E. Here are some of the add backs that are useful to your debt to income ratio. Here are the ones that will hurt you if you're trying to qualify this year. Optimizing credit assets, all of those things is a large part of what we do in that education sphere that I mentioned. And then secondly, we're not a one-size-fits-all. We have a very diverse menu, I like to call it, of loan programs, much of which are catered to investors. We're full service. We do everything, VA, FHA, USDA, all of that stuff. But we do have some special skill sets for investors. And some of those loan products include, you've got your agency Fannie Freddie, okay? You've got non-QM products. I won't go into that unless you guys have questions about it specifically, but basically, if you don't fit into the Fannie Freddie box, you've got all these non-QM, a lot of which investors take advantage of. It's not just for investors. We have short-term bridge loans for fix and flip or fix and hold. We have ground-up construction, if you're into that. We have my favorite, the all-in-one, that's a first lien HELOC. If anybody has any questions about that, let me know. We're going to be talking about our second lien HELOC options for non-owner occupied. We have commercial products that can apply to commercial property, but also there could be a play to use commercial products for residential properties, some kind of a cross-collateralization where you're trying to open up Fannie Freddie golden tickets, right? If you wanted to look at that, and quite a bit more. You get my point, okay? We're not going to be everything to everybody, I realize, but we do have quite a diverse playbook of products that most investors can take advantage of. Okay. And if you guys have questions, please feel free to just interrupt me. That's what I'm here for. John, how much time do I have?
Caeli, we like to do about 20 minutes of presenting, open it up to questions on record, right, in the recording, and then we'll shut the recording off and see if there's questions that people want to ask after the recording's over.
Okay. So now that I've bored you guys with my resume, let's go and get into the second lien HELOC. So newer to the playing field, second lien HELOCs for investment purchases. We had those a couple of years ago, but with the pandemic and all of the upheaval in secondary markets and lots of other reasons, they kind of went away. We couldn't find any second lien for quite a while. PenFed was doing them, Bank of the West was doing them, maybe a few others here and there, but they shut that all down. And I think we're one of just a handful that are still offering second lien home equity line of credit, open-ended line of credit on investment properties. And I think the reason that a lot of people are very interested in this is because of the interest rates we procured in 2020, 2021, right? We got those 3 and 4% interest rates. Thank you. Very nice. But and not wanting to refinance those, which I have my own feelings about, that's beside the point. We want to tap into our equity, anything that we've earned in appreciation. We want to harvest that equity, and then borrowed funds are non-taxable, right? Then take that and redeploy it for other investments, probably. That's the point. The only way to do that without a full refinance is a second lien HELOC. Is everybody familiar with what the HELOC is and the open-ended versatility of it? Does anybody need any quick explanation of how a HELOC works? Jonna, what do you think?
Yeah, let's do a real brief, what they can use it for.
Well, it's up to your discretion. So a home equity line of credit is an open-ended mortgage. In this case, it's in second lien behind your first lien. That one stays in place, where you can draw from it and pay it back down and draw it back up and pay it back down at your discretion. The product, I'm just going to give you the highlights of this particular product, the guidelines for it, and then you guys can ask questions. So this is a 70% CLTV. That stands for combined loan to value. As an easy math example, let's say that just for round numbers, let's say that the value of the home was $100,000. And let's say you owed $50,000 on a first mortgage. Well, we can go 70% of 100,000. So that's 70,000. We back out the 50,000 first lien mortgage. That would leave you with a $20,000 line of credit. Okay, that's 70% CLTV, combined loan to value. You can draw out what you want. You can pay it down, draw it out. This line of credit is valid for 3 years. It's a shorter term. One of the reasons that I like our first lien HELOC, the all-in-one, it's quite a bit more complicated at its concept, because the all-in-one as a first lien HELOC is something called the velocity of banking, infinity banking, if you've ever heard of that. That's what the all-in-one is. But the second lien is for 3 years. You have access to the line of credit undisturbed for 3 years. It's interest only for 10. So after the first 3 years, it's going to cut off access. You will not be able to access it anymore. But the payment based on the outstanding balance is still interest only. So you can accelerate payoff pretty quickly with anything over and above. And then after that 10 years, it's a 20-year repay. It becomes principal and interest payments over a 240-month amortization, which is the equivalent of 20 years times 12 months. That's how you get 240. So the amortization shortens out at the end of the first 10 years. Credit scores require, I think the lowest is 680. The higher the credit score, the better the margin. And when I say margin, what we do on any adjustable, this doesn't apply just to our second lien HELOC, it applies to any mortgage that has an adjustable rate feature. All indexes or all HELOCs will. The margin plus an index, those two numbers added together will equal your fully indexed rate and what the interest is calculated on. The higher the credit score, the lower the margin, right? So that lower number added to the index, which by the way, is based on the prime, US prime rate, that's currently posting at 8.5%. So let's just say, for example, your margin was 4, okay? 4 plus 8.5, your fully indexed rate would be 12.5% as an interest only. And just an easy way to calculate that, you guys, if you want, somebody wants to get out a calculator and just do the math, this is how you're going to calculate your interest only. It's so easy. You're going to take whatever the fully indexed rate is. Let's just use my example at 12.5 because I just threw that out there. Take $100,000 times 12.5%, divide that by 12 months. That would be an interest only payment of $1,041. Okay. So you take whatever the balance is times the fully indexed rate, divide by 12, and that's how you'll figure out what an interest only or simple interest is. Let's see, debt to income ratio max is 50% on these loans. It is a full doc loan. It can't be used on a debt service ratio where we're just looking at the property's income divided by the payment. Those are not allowed for this. Must be full doc. I pulled up, actually, I can look at my cheat sheet, you guys, and give you some other high level. 740 and above is going to be the best rate. It goes down to 780, or excuse me, 680. I was correct. That's the minimum credit score required for this product. The initial draw is required to be 50,000 or 50% of the total line limit, whichever is greater. You've got the life cap is 18%. So no matter what happens with the index, prime again, plus that margin, whatever that ends up being, it can never exceed 18%. The floor rate can never be less than this is 4%. Max line limit is 500,000. The minimum line limit is 50,000. Can't have more than 10 financed properties and qualify for this product. So if you have more than 10 financed and you really need a second, what I would suggest is if you have smaller loan balances on any of your investment properties, if you've exceeded that 10 limit, perhaps taking equity from another property and paying those off to get below that 10 limit so that you can qualify, and then doing cash out refinances against the others if you wanted to. Texas is tricky. If you guys have properties in Texas, we can do second liens in Texas. And I think as long as it's not a piggyback, meaning a first, second combo, if it's just a standalone second, that's fine. I think that in Texas, because Texas does have some weird rules when it comes to lines of credit. As long as it's a standalone second, which means it's just on its own, we're leaving the first in place, versus a piggyback would be if you're purchasing a property and you want to put, 60% first lien and a 10% HELOC second for that 70% CLTV max. They're not letting us do that in Texas. Let's see. You can choose on the appraisal. You can choose between a full appraisal, which in some cases you may want to do because maybe it gives you extra value for a higher limit. If there's extras in the property that won't be seen from just an automated, we can just run a desktop review where they're not actually going out to the property. So you guys get to choose one and the other. The cost difference is considerable. If it's just a desk review, it's probably about $250 versus a full appraisal on an investment property can be as high as $600-700. So depending on some of those variables, you guys get to choose. Points are, I want to say 2.5 points is what's charged on this. Eligible properties, single family, planned unit developments, modular homes are allowed as defined by Fannie Freddie rules, condominiums that are warrantable condominiums, and 1 to 4 unit properties, so up to 4-plex. Condotels, co-ops, mobile homes, manufactured homes, commercial, that kind of thing are not eligible properties for this. That's probably good. Why don't I pause and open up for whatever questions you guys have so far?
Sounds good. We have our first question, Patricia put in the chat. When does one fit in and not fit in for Fannie Freddie?
So not in connection with the second lien HELOC, a Fannie Freddie loan. Those are full doc loans. So we need your personal income divided by your individual monthly debt. Okay, so this is kind of a misunderstanding when people think about debt to income ratio, which is usually the bigger component of qualifying conventionally. I don't care about the overall debt that the individual has, right? The balances on credit cards or on mortgages, whatever. All we're looking at is the minimum monthly payments. We're going to divide that number by the monthly income that we've extracted from the documentation you have supplied us. If you're just a straight W-2 wage earner, we're going to take your gross income. If you make $120,000 a year gross, I have $10,000 a month of income. Okay. The max debt to income ratio conventionally is 50%. So as long as $5,000 covers all the minimum payments on the credit report, now there's 3 exceptions to payments that must be included in a debt to income ratio calculation, but will not be found on a credit report. Those would be if you're a renter, a primary housing expense has to be included in the debt to income ratio. And if you rent for your primary housing, it's not going to be on your credit report, right? So that would be one thing that has to be in there, not found on credit. The second would be HOA dues. And then the third would be if you have mortgages where you have elected to pay the taxes and insurance yourself, separate from that mortgage payment, the credit report's only going to show the principal and interest, right? So those 3 things are the only exception to what goes into that calculation. Monthly minimum liabilities on that credit report divided by the monthly income. And if any one of those 3 things applies to you, you got to add that in too. And the reason that I go into the trouble to explain all that is because people mistakenly assume that other ordinary living expenses somehow play a role in calculating DTI, and they do not. Food, gas, utilities, cell phone bill, entertainment, whatever those other things are. If they're not on that credit report as a minimum payment, we are not going to count that. Okay, it will not go in the DTI. 50% is the threshold. The other thing to consider when we're talking about this is that for rental properties, the liabilities play a role. However, those also have income. So there's a separate calculation for income versus liability when we start adding in the rentals. I won't take you down that rabbit hole, but just to say that 50% is the max. Conventionally, you can't have more than 10 finance conventionally. 650 or better credit score is typically what you want to see on a conventional. A lower credit score is allowed conventionally if they have compensating factors, things like low DTI or strong assets. Those are compensating factors that maybe a lower credit score would get approved for a conventional mortgage. The down payment on a conventional mortgage for investment purposes cannot be borrowed and cannot be gift funds. It has to be your sourced and seasoned funds. And sourced means it has to have originated with you, and seasoned means 60 days. So if I have 2 months worth of bank statements for your assets, that's for your down payment and the reserve requirement. If I have 2 months worth of bank statements to show me where your funds are coming from, if there's any large deposit listed in there, and a large deposit will be anything over 50% of the income that we give you. Okay, if I see a large deposit, I'm going to come back and say, Jonna, where did this money come from? If you can say, oh, well, I just got a bonus at work, or I just liquidated some stock, or I just sold a vehicle. All of those things are perfectly acceptable. I can paper trail that as associating originated with you. If great aunt Alice said, hey, here's 50 grand, go invest in real estate, those funds are not sourced and seasoned yet and would not be admissible. We'd have to back them out of the total. So in that case, depending on the cycle of your banking, let's say it's the 1st through the 30th, if great aunt Alice put in 50 grand today, I don't want March's statement, but April and May would be acceptable for that 50,000 to be usable as source and seasoned funds. The reserve requirement for conventional, actually, I may share a screen for this. Hopefully this is helpful, guys. What am I doing here? Let's go here, share. Let me bring it up. Give me 1 second. So the reserve requirements, okay, and if you guys need this, somebody tell me and I'll forward over to Peggy or Johnny and you can give it to the crew. So what you're looking at here, this is conventional, this is the reserve requirement. The down payment on an investment property has to be liquid. Liquid is checking, savings, money market accounts. HELOCs are liquid. Your retirement accounts, your 401k, your whole life insurance policy, your self-directed IRA, those are retirement assets, non-liquid. The reserve can be both. It can be either liquid or non-liquid. Your down payment has to be liquid. If it is non-liquid in a retirement account, we need to make sure that the terms of withdrawal, the TOW, support. If it's 401k and you can only have one loan out at a time because the terms of withdrawal say you can't have more than one loan out, and you already have one loan out, whatever the difference in that account are, you can't use it for reserves until you pay off that loan, okay? But otherwise, liquid and non-liquid are allowed for the reserve requirement. I'm going to draw your attention right here to the 2%, 4%, and 6% bullets, you guys. And I know I'm talking fast, but this is being recorded, thank God. So you can go back and watch it later if you like. So depending on how many finance properties you currently have will dictate how we're going to calculate the reserve requirement. If you have 1 to 4 finance properties, we're going to take 2% of the unpaid principal balance of the rental properties only. If you have 4 and 6 finance properties, we're going to take 4% of the unpaid principal balance, UPB. And then if you go 7 through 10, it's 6%. Now, your primary residence will be included in how we determine 246%, but the unpaid principal balance of the primary where you live is not included in the actual calculation. It's only used in determining which one of these buckets you fall into, 246, all right? In addition, I'll give you guys an example in a second. In addition to this, the subject property, okay, so this is what you already own, 246%, example to follow. The property that you're purchasing at that time or refinancing at that time, we need to calculate 6 months worth of PITI, principal, interest, taxes, and insurance, and HOA if it's applicable, and add that number to whatever the calculation is here. So the easy math example that I give, I just take it all the way up to the 6%, okay? You're purchasing the 10th finance property, which is your 9th rental. Number 1 is your primary, so it counts in the number count, right? But number 10 is a rental. So you've got 9 rentals and 1 primary. In my example, I'm going to say that properties 2 through 9, that's 8 properties, have unpaid principal balances of 100 grand each, just to keep the math easy. 100,000 each times 8 is 800,000 of unpaid principal balance, times 6% is 48,000. Then I have to add the subject property's 6 months of PITI. To keep the math easy again, let's say that that's $1,000. The PITI is $1,000 for my subject, number 10. Times 6 is 6 grand, plus 48,000 would be $54,000 that individual would need to show in reserves for a conventional loan, if that was their scenario. Okay, now if you guys want this, happy to provide it. Feel free to look at it. There is a second page that gives you a more realistic, in reality, breakdown of this. I like mine better because it's just easier to follow. But should you guys need or want this, just let me know and I'll send it over to whomever can use it. But conventionally speaking, those are kind of the basic rules. You can't have more than 10 financed, and that only applies to rentals, guys. You could have 20 investment properties and then go get a Fannie Freddie loan for your primary residence. That 10 limit does not apply to where you're going to reside. It only applies to the rental properties. So you got a 10 limit, you got 50% debt to income ratio. We talked about that. We've got, I would say 650 is probably the low end of what you can qualify in a credit score. Be prepared to have compensating factors in the 650, low DTI, strong assets, and your interest rate's going to be higher. So be prepared for that. And then finally, the assets required. We talked about cash to close, liquid, non-liquid, and then the reserve requirement as we're seeing here on our screen. But those are the basics, right? And if anybody needs a quick back of the napkin, hey, do I qualify based on this? Just let us know. I'm sure our contact information is available somewhere, I think, Jonah, right? Anyway. Okay, what's next? Oh my God, did I not do that right? Oh my God, watch this. Were you guys just looking at a blank screen this whole time? Did anyone see this?
No, we were looking at the.
We saw the document you were showing.
Yeah, we saw the reserve.
Okay, I'm looking at my screen and it shows the Zoom. Okay, you guys can see this, right? My mouse is spinning.
Yep.
Oh,
yep. You're good.
Okay. Whew. Okay.
All right, you can stop sharing and we'll go to questions.
Sure.
Anybody have any questions?
You guys are going to take it easy on me today.
Well, we are, yeah, why don't you, while we're thinking of our questions, sometimes we're a little slow on our questions.
Sure. No
put your contact information in the chat.
Sure. I'll just put our website and then our email and phone number, guys, if you need it.
Hey, this is David. I had a quick question.
Sure.
As far as qualifying, I kind of missed the presentation. Sorry about that. I'm just curious if the investor doesn't have or showing a lot of income, what is your criteria as far as your loan products?
Yeah. So first, I would not just assume. If you've been told that your DTI is too high, you don't have a lot of income to qualify, I would challenge that just to make sure they don't have overlays, because a lot of the big boy banks, the credit unions, they're not going to give you certain add backs. They won't give you credit for this or that. I would just want to make sure that we exhaust the possibility that you can't, in fact, qualify conventionally with just a normal DTI. And if that were the case, 2 things would follow. One, if you want to get back into play with a conventional type loan, we would plant some seeds with you and show you how to get there. And in the meantime, we would use debt service coverage ratio as a product. If you missed this, David, Ridge has a very diverse product line or menu that includes the Fannie Freddie, vials of blood and DNA samples. We have debt service coverage ratio products where it's just going to look at the property's income, the gross income derived either from the lease or the appraisal. Doesn't have to be tenant occupied. We'll use what the appraiser thinks is market rents for that property type in that area. And we're going to take whatever the amount is, the gross rents, and we're going to divide it by the PITI. To qualify, it can be, that number can be as low as 0.75. Example, if the gross rents were $1,000 and the PITI was 750, that would produce a debt service coverage ratio of 0.75. That is as low as we can go. And be prepared that for debt service, if you fall in the 0.75 to 0.99 bucket, rates are going to be tough. They're going to be high, but we can still do it. The middle of the road for debt service is usually we see them come in at 1.0 to 1.24. That's just pretty standard. At 1.25 and above, you can expect interest rates to improve a little bit. So to answer your question, sir, if we know for sure you can't qualify conventionally, we would put you into debt service coverage ratio probably. We also have bank statement loans. So if, you cannot, and the less documentation you supply, the less skin in the game you have, the higher the terms or less attractive the terms are going to be. So if you can show bank statements, let's say 12 months or 24 months of personal or business bank statements, we add up all the deposits together and divide it by the number of months that you gave us, and we'll be able to use that as the income to offset any monthly debt. That's going to produce slightly better terms than a debt service coverage ratio would, because you've got a little bit more skin in the game. You're able to show some form of income. Additionally, you have asset depletion. So for those that have lots of assets in a brokerage account or whatever, asset depletion will allow us to come up with a formula or a value that says you got $1 million in here divided by either 120 months or 36, depending on a product. This is the income that we can give that person, and then offset the monthly liabilities. Fannie actually has an asset depletion as well that we could consider for those that have large assets sitting but no income to speak of. Does that answer the question, sir? Maybe too much.
No, I appreciate it going into detail. Based on kind of the scenarios, what kind of rates we're talking about between the three?
Yeah. And while we get into rates, I know that that's the hot topic. I want to preface just to say this, okay? There's a psychology about interest rates, and I'll give you actual numbers that I want you guys to really look at and do the math, largely depending on the loan size. The difference between a Fannie Freddie at 6.8 versus a debt service at 7.6, okay, whatever, 6.8, 7.6 on a $100,000 loan size is probably $25 a month. So I'm not saying that rate isn't important. I'm not saying that we don't want the lowest possible interest rate, but if it's the difference between qualifying and not qualifying, just make sure you're doing the math and you know what the actual payment difference is between an eighth or a quarter or a half or a full point. That's all I mean. Interest rate differences between, and when we talk about rates, you guys, it's very important to quantify that it's largely dependent on the characteristics of that transaction. So there's something called an LLPA, loan level price adjustment, that is a positive or a negative number that attaches to the individual characteristic. These are going to be occupancy. A loan level price adjustment between an owner occupied where you live and a non-owner occupied that you rent out is a big difference. Loan size, loan to value, property type, purchase versus refi, cash out versus rate and term, credit score, right? All of these different things play a role in determining the overall interest rate. If we're comparing apples to apples, the difference between, a Fannie Freddie loan of 150 loan size, 25% down, 760 or greater credit, and a debt service of all the same characteristics, except for there's no income, no DTI, it's probably 0.5 to 0.75 percentage point different. So if we're at 7 on a conventional Fannie Freddie, you can assume maybe 7.75 on a debt service ratio loan on average, right? There's too many moving parts to know for sure, but that would be a good benchmark anyway, sir.
Thank you. Appreciate it.
You're welcome.
Caeli, I have a question. I want to go back to right at the beginning when you talked about education. Can you tell us a little bit about, do you have an education program? Do you have a show?
Yeah. Yeah, thanks, Jonna, for asking. So I used to do every Tuesdays, and it kind of conflicted with the nest egg builder in terms of that. But I have since live with Caeli on Tuesdays. I'm not doing that anymore. I'm doing once a month. It's live Q&A with me. It will be on a Tuesday. My team is figuring that out. If you guys want to be a part of that, just email info@ridgelendinggroup.com, and we'll make sure to get you in with our, drip marketing and email. You'll see those come up. I record a lot during the week on just little snippets of information I think is useful. Those will all be found on Ridge Lending's YouTube channel. Feel free to check that out. And then finally, and I think what most people will find value in, there's something called Certified Power Buyer, okay, CPB. This is free education, one-on-one with me, with yours truly, where after an individual has applied and provided their vials of blood and DNA samples, and we have a baseline understanding of what their qualifications are, they get time with me. Usually there's 3 or 4 separate conversations. They're about 30 minutes a piece. And we dig into what their goals are. And then we combine that with what their qualifications are. And I help them plant some seeds and create roadmaps and fill in those blanks in education so that, they're better prepared and more informed. And like I said, that's free. Certified Power Buyer with me. Help you kind of strategize, tell you what you've got, what you're working with, where you want to go, how do you maximize those things for this year, next year, 5 years. Those would be the ways.
That's great. If you can, when you have a time and date for that, we can probably send that out to
The live with Caeli, the Q&A.
Mhm.
Sure. I'll try and have Carly or Christina send that over to Peggy. Who would that go to, Jonna?
Yeah, to Peggy.
Okay. If you guys, I don't know if this is, I'm out of line by even saying, but if you guys wanted to email info, you'd be in our database. If you just want that information, that's fine. Just let us know. We'll take you off the emailer. And actually, no, if you mark do not contact, I don't think you'll get those updates. I'll do my best. I'll do my best to have that. And if it changes, you won't be notified, and we probably won't have the resources to update Peggy every time, but we'll try.
Well, what are you seeing out there right now? Is it in the both the consumer market and the investor market?
So you mean just housing, lending, transactions, purchases? Tell me what you mean.
Yeah, activities. Is it are people making transactions? Are they getting approved?
Yeah. Yeah, it's quite robust. We had, a little bit of a reprieve for interest rates late last year, early this year. They've gone back up a little bit. I'm probably not the right person to talk to about rates. I have my own very distinct opinions about it. And I feel like sometimes it comes off as I'm trying to sell people because this is my business and I want their loan or something. But truly, as a fellow real estate investor, you guys, it shouldn't be about the rate. And if all you're doing is focusing on the rate, then you are missing out on opportunity for a lot of reasons. One, you're probably not doing the math, or maybe you're not doing it right. But if all you're waiting for is an interest rate that's at 7 to come down to 5, you're doing it wrong. You're not looking in the right market if it doesn't make sense. You're not diversifying in short-term, mid-term rentals, 2 to 4 units. But to answer your question, John, I got off on a tangent, didn't I? Yes, we're still doing very high volume, non-owner occupied all over the United States. We're seeing seasoned investors doing just that, finding ways to get the returns, even in a slightly higher rate environment. And remember, you guys, people have short memories. I am guilty of this myself. We are not in a high rate environment. We are in a high rate environment considering where we just came off of. But historically speaking, we're not far off from the average historical rate, long-term 30-year fixed rate. I'm anxious to see the inverted yield get off the rails so that we have access to ARMs again that are a half to a full percentage point better than 30-year fixed. Because the truth of the matter is, here's another psychological piece that people get stuck on. A 30-year fixed doesn't have any place in the investor realm or world. Okay, we are investors. Unless you know for sure you're going to keep that mortgage and make 360 payments later, which, by the way, you would be a fraction of a percent of people that do that. The average shelf life is about 5 years, for non-owner occupied before they're refinancing, pulling cash out, reducing their interest rate, or selling it in a 1031 exchange. So I'm a big, big proponent of an ARM, an adjustable rate mortgage, when secondary markets are producing a valid improvement to the 30-year fix. Right now, that inverted yield I started off with means that this is post 0809. Okay. Who remembers 0809? I got my you-know-what kicked in 2008, 2009, and the years trailing that. But as a result of that, we're on an inverted yield. So that means that 30-year fixed mortgages, more often than not, are producing a better rate than an ARM. So there's no incentive to look at an adjustable rate mortgage right now. When that flips back, okay, then we will be hopefully in a place where an adjustable rate of 5-year, 3-year, 7-year, whatever it is, the interest rate is a half or a full percentage point better than its counterpart 30-year fixed and more reasonable to be looking at. So for right now, I think the all-in-one can make a huge impact for investors that still want to be able to cash flow. If you guys want more information, I think I might have talked to the Nest Egg group at one point a year ago or something about the all-in-one, but it's a very unique vehicle or vessel that will allow you to cash flow in a way that you never would be able to with a 30-year fixed mortgage, even with this high rate environment we find ourselves in. Otherwise, if you're just dead set, fine, wait for them to come back down. They always come back down slower than they go up, unfortunately. My prediction is June, July, before we see the Fed take down that Fed fund rate. How that will translate into the long-term rate, because remember, those two things are not the same. They're linked, right? They tie together, but the Fed fund rate and the 30-year bond are two very different indices. I went overboard on that one too, Jonna, but yeah, we're very busy. We'll still seeing lots of volume. I think more than anything, we're seeing that investors are being smart about diversification. If they were in this market and it wasn't working anymore, they're looking for markets with lower taxes, perhaps Section 8, short-term rentals, things that they can find profitability in.
Excellent. Thank you. Any more questions before I turn off the recording? All right. Caeli, thank you very much.
You're welcome.
If you'll hang on here, I will finish this up. It's always a pleasure to get new information.
You bet.